Private equity funds use two primary financial measures when it comes to assessing potential and existing investment returns, which are internal rate of return (IRR) or cash return. Let's go through them in detail now. Internal rate of return or IRR is the primary metric by which private equity funds gauge the attractiveness of a potential LBO, as well as the performance of their existing investments. IRR measures the total return on a fund's equity investment, including any additional equity contributions made or dividends received during the investment horizon. It is defined as the discount rate that must be applied to the fund's cash outflows and inflows during the investment horizon in order to produce a net present value (NPV) of 0. Although the IRR calculation can be performed with a financial calculator or by using the IRR function in Microsoft Excel, it is important to understand the supporting math. Here we show the equation for calculating IRR, assuming a 5-year investment horizon. While multiple factors affect a fund's ultimate decision to pursue a potential acquisition, comfort with meeting acceptable IRR thresholds is critical. PE funds typically target superior returns relative to alternative investments, with a 20% plus threshold historically serving as a widely held rule of thumb. This threshold, however, may increase or decrease depending on market conditions, the perceived risk of an investment, and other factors specific to the situation. The primary IRR drivers include the target's projected financial performance, purchase price, and financing structure, particularly the size of the equity contribution, as well as the exit multiple and year. As would be expected, a PE fund seeks to minimize the price paid and equity contribution while gaining a strong degree of confidence in the target's future financial performance and the ability to exit at a sufficient valuation. Let's try an example. We assume here that a fund contributes $250 million of equity cash outflow at the end of year 0 as part of the LBO financing structure, and receives equity proceeds upon sale of $750 million cash inflow at the end of year 5. Putting all these into the IRR formula, we can see that this scenario produces an IRR of 24.6%, as demonstrated by the NPV of 0. In addition to IRR, PE funds also examine returns on the basis of a multiple of their cash investment. Cash-on-cash return is a rate of return ratio that calculates the total cash earned on the total cash invested. The difference between IRR and cash return is that IRR factors in the time value of money when it calculates returns, whereas the multiple is simpler and ignores time value of returns. Hence, most venture capital firms and early-stage investors focus more on earning a multiple of their money back. They don't care that much about IRR, because they're going to be invested for a very long time. Using the same example again. Assuming a fund contributes $250 million of equity and receives equity proceeds of $750 million at the end of the investment horizon, the cash return is 3.0x. This is calculated by simply dividing the cash inflow of $750 million with $250 million of initial cash investment. This of course assumes that there are no additional investments or dividends during the period.